Thank you. Mr. Young.
Well, thank you, Mr. Chairman. Thank you to all of our panelists for testifying here today. Really appreciate all we've learned, and I want to thank the chairman in particular for making permanent the CFC look-through provisions in the draft and holding a hearing so that we might discuss that provision in particular a bit further. I have concerns about our intellectual property intensive related firms and also our continued investment in R&D, which as we all know is essential in this modern economy we live in. So we'll look forward to working not only with fellow members of the Ways and Means Committee on that, but other stakeholders as we try and improve the international sections of the draft. That's a sort of a lead-in to R&D. Ms. Zalesko, you indicated something that many of us have read, and I think many of my constituents intuitively understand, which is that the U.S. doesn't have a monopoly anymore on global R&D. In fact, you cite a figure, since 2001, the share of the world's R&D performed in the U.S. has decreased from 37 to 30%, and to the extent we can arrest that trend line, that would be a good thing. I think we'd all agree. Can you talk about what role tax policy plays with respect to that dynamic?
The companies look at the world on a global basis. We're no longer international, we're global businesses. So therefore, looking to where you're going to deploy your R&D is important, and therefore the impact of tax policy plays a part and is a factor. So this is an opportunity for the U.S. to lead as far as where do we want this technology. Do we want it here? Do we want it outside the United States? I think we want it here. It provides jobs. It provides innovation, technology, and from that technology spurs other technologies. So I think good tax policy is going to look at a broad-based, simplified, something that's administrable. I think the alternative simplified credit provides that. I would encourage that it be increased to 20%, according to, I think, as far as being truly an incentive, and also the broad base on the qualified research expenditures that would qualify for the credit, I think is important. Because when you look around the world, they're not reducing the expenditures, they're increasing them, or they're increasing the amount of the credit or the multiplicand on the deductibility of the particular expenditure. So I would think good policy would be broad-based with regard to what would qualify for qualified research expenditures and the actual amount of the incentive.
So it needs to be, in short, made more inclusive, more generous from your vantage point, but you certainly support the permanency of the provision.
Absolutely. I mean, that's critical. I mean, I think that's sort of like a baseline, that you need to have permanency. I mean, when you're making business decisions, you're not, especially in the R&D area, you're looking out, like I mentioned, 4 to 5 years. So you need certainty with regard to that it's going to be there during the entire process.
Thank you. I represent a district in south central Indiana, southern Indiana, and it's very diverse economically. We have a fair amount of small, medium-sized manufacturing, certainly IP-rich firms, both in the district and around the district, and also agriculture plays a significant part in our economy. So, Mr. Stallman, pivoting to the ag sector, you've described the Farm Bureau's perspective, if I could get that out, related to the impact of the $250,000 Section 179 threshold versus a $500,000 threshold. And why is the higher level so important to your members? It pertains to just the ability to buy more farm equipment. You need a more generous level to incentivize them to do so. That's correct?
Yeah, the difference, and I tried to convey that in my oral statement, the difference between the $500,000 and the $250,000 is primarily related to what we're seeing in the cost of the equipment and the capital expenditures we have to make in agriculture is continuing to increase very rapidly, and frankly, while $250,000 10 years ago used to buy you a lot of equipment, not so much anymore, and so that's why the $500,000 is very important.
So the inflation of those costs is certainly something we need to take into account, balance that against a lower 25% rate, and I guess every individual farm is going to have to come up, individual operation, with the sort of net impact, but does the Farm Bureau have a policy articulated with respect to that trade-off?
No, we don't. We are looking at the whole draft proposal to see where those trade-offs are. It would vary tremendously across individual operations. You know, as a general rule, that expensing provision, I think, would probably have more positive impact on farms and ranches in the way they make the decision, even though it's not, you know, tax avoidance because you're just postponing paying the taxes, than perhaps lower rates. And once again, it would depend on the rates.
Thank you.